BlackRock Incorporated, a global leader in asset management, has recently expanded its product offering by introducing actively managed exchange-traded funds, ETFs, to cater to the evolving demands of investors. In this comprehensive analysis, we will delve into the nuances of BlackRock's foray into the active ETF space, explore the factors behind the surge in interest in actively managed strategies, and provide in-depth market commentary on this rapidly evolving landscape. The active versus passive debate. The financial world has long been entrenched in a debate over the merits of active versus passive investment strategies. Passive investing, which involves tracking established market indices, has garnered immense popularity due to its low fees and simplicity. However, the changing market environment, characterized by increasing interest rates and inflation, has caused a notable shift in investor sentiment. Active management on the rise. Amid this shift, investors are increasingly seeking out actively managed strategies, particularly actively managed ETFs, which aim to outperform the broader market. The trend toward active management is evidenced by significant fund flows into these strategies. According to Morningstar data, active ETFs have attracted a staggering $79 billion in investments through September, representing approximately 25% of all ETF inflows in the United States. This trend highlights a pivotal change in investor preferences, as they seek to adapt to changing market conditions. BlackRock's entry into the active ETF space. BlackRock's response to the evolving investment landscape was the launch of its actively managed ETFs. The BlackRock Large Cap Value ETF, BLCV, introduced in May, marked a major milestone for the company, as it was the firm's first stock ETF designed to be a primary holding for investors. Since BLCV's launch, BlackRock has rolled out over a dozen active ETFs, demonstrating the company's commitment to this new strategic direction. BlackRock's active ETFs, a closer look. The recent addition to BlackRock's active ETF lineup, the BlackRock Large Cap Core ETF, BLCR, solidifies the company's presence in the active ETF space. BLCR is designed to meet the demands of investors who seek strategies aiming to outperform the market. It builds upon the success of BLCV and enters the market under unique circumstances. BLCV's modest asset accumulation. Since its launch in May, BLCV has gathered a relatively modest $6 million in assets. The fund's focus on value stocks, which have faced headwinds in the current market environment, has played a role in its performance. Value stocks, represented by the iShares Russell 1000 Value ETF, IWD, have experienced a year-to-date loss of 2.4%, in stark contrast to the 21% gain achieved by the iShares Russell 1000 Growth ETF, IWF. Additionally, BLCR offers a competitive edge in terms of fees, with a net expense ratio of 0.36% compared to BLCV's 0.55%. BlackRock's unique approach to active management. One noteworthy aspect of BlackRock's active ETFs is their distinctive approach to portfolio management. These funds employ a combination of both fundamental and quantitative analysis in their stock selection process. While BlackRock has not disclosed specific details about the methods employed, this dual approach reflects the company's commitment to employing a diverse range of strategies to achieve optimal results. The challenge of active management. Despite the appeal of active management, it's essential to recognize the challenges that active managers face. Historical data has consistently shown that active managers have struggled to consistently deliver outperformance over the long term, even after accounting for fees. The S&P Dow Jones Indices versus Active, SPIVA, scorecard, which compares the performance of active managers against passive benchmarks, has highlighted that a majority of active managers underperform their passive counterparts. The persistence of the quest for outperformance. Investor sentiment is a complex and multifaceted phenomenon. While passive strategies provide cost-efficient and straightforward exposure to broad market movements, active management has the potential to offer alpha, or returns that exceed the market benchmark. The desire for outperformance remains a strong motivator for certain investors, even in the face of historical data indicating the challenges of consistently achieving it through active management. Nate Geraci, president of the ETF Store, noted that the market environment has indeed shifted over the past 2 years, driven by factors like rising interest rates and inflation. These changing conditions have led many investors to reconsider the suitability of traditional passive investment strategies, sparking their interest in actively managed options. The future of active ETFs, a market perspective. BlackRock's venture into the active ETF space aligns with a broader industry trend of blurring the lines between active and passive investing. Investors today are seeking a combination of both approaches, as evidenced by the interest in smart beta ETFs and other innovative strategies that blend elements of active and passive management. The convergence of these approaches is reshaping the asset management industry. Market commentary: factors driving the rise of active ETFs. A variety of factors are contributing to the growing popularity of active ETFs. Market volatility: the past few years have seen heightened market volatility due to events like the COVID-19 pandemic, global economic uncertainties, and geopolitical tensions. In such an environment, active managers have the flexibility to adjust portfolios and seize opportunities. Interest rates and inflation: rising interest rates and inflation have raised concerns among investors, making them more receptive to active strategies that can adapt to changing economic conditions. Innovation in ETFs: the ETF industry is experiencing a surge in innovation, with the introduction of actively managed ETFs and smart beta strategies. This expanding array of investment options provides investors with more choices to tailor their portfolios. Evolving investor preferences: investors today are increasingly looking for investment solutions that align with their unique objectives and risk tolerance. This has led to a greater demand for actively managed strategies that can cater to specific investment goals. Regulatory changes: regulatory developments have facilitated the growth of actively managed ETFs, making it easier for asset managers to launch and operate these funds. BlackRock's commitment to actively managed ETFs. BlackRock's active ETFs represent the company's commitment to staying at the forefront of innovation in the asset management industry. By introducing a range of actively managed funds, the firm is positioning itself to meet the evolving needs of investors. BlackRock's investment in technology, research, and human capital enables it to deliver competitive results in the dynamic world of active management. Market commentary: the growth of active ETFs. The growth of active ETFs is a testament to the changing dynamics in the asset management industry. Here are some key market observations. A niche in the market: active ETFs have carved out a niche in the market by offering investors an attractive combination of active management and the structural advantages of ETFs, such as intraday trading and transparency. This unique blend has resonated with investors seeking a balance between active and passive strategies. Asset allocation solutions: active ETFs are increasingly being used as core holdings in investors' portfolios. These funds can serve as effective asset allocation solutions, providing diversification and risk management. Smart beta strategies: alongside traditional active management, smart beta strategies have gained prominence. These strategies seek to capture specific factors or investment themes, allowing investors to implement precise investment strategies. Factor investing, factor-based investing, a subset of active management, has gained traction. Factors like value, growth, quality, and momentum are used as the basis for constructing portfolios, providing investors with the flexibility to target specific risk factors and market anomalies. Conclusion: BlackRock's foray into the active ETF space is emblematic of the shifting investment landscape. As investors increasingly seek strategies that offer the potential for outperformance, BlackRock's dual approach of combining fundamental and quantitative analysis represents a commitment to delivering competitive results. The success of these active ETFs will hinge on their ability to navigate market fluctuations and deliver the outperformance that investors are pursuing in an increasingly complex financial landscape. The rise of active ETFs underscores the idea that the lines between active and passive investing are becoming increasingly blurred. Investors are diversifying their portfolios and exploring a broader range of investment options that cater to their specific objectives and risk tolerance. BlackRock's entry into this space positions the company to meet the evolving needs of investors and capitalize on the opportunities presented by the growing demand for active strategies. The future of active ETFs is likely to be characterized by continued innovation and adaptation to the ever-changing financial landscape.